The other option is that the Fed can do what the UK did, which is with, if the treasury market breaks, they might have to come in and do surprise buying of long duration bonds. And if they want to be conservative about it, they could try to sell short duration bonds to offset that. So they can say, okay, well, we're still holding our balance sheet flat, but we're twisting the duration of bonds we hold. So that they have a range of options that they can do, but they're kind of variations on the theme of money printer go burr, right? So when the sovereign bond market breaks, it basically, you need more currency, more reserve creation, or more leveraging to buy those bonds. And that's kind of the, right now the biggest question in macro is how much can the Fed tighten in their quest to rein in inflation, and will something like that break and force the Fed to pause or pivot earlier than they'd like to. And so that I'm watching the treasury market pretty closely to see how close they might be getting to what we just saw happen to the UK bond market. So I'd be looking at liquidity. One is yields, right? So if yields keep grinding higher on the long end of the curve, that's an indicator. Number two, I'd be looking at liquidity conditions, right? So for example, Bloomberg has an index of government bond market liquidity, right? So there are various ways to quantify this. And so you just look for quantitative measures of, reduction in quality and liquidity in what is supposed to be a very liquid and safe market. And we are seeing signs of that. It's basically, most things are showing that it's about as bad as it's gotten, except for March 2020. That was worse. It's not fully broken like it did then. March 2020 in the US looked like what just happened in the UK, basically.
Right.
And so we're not there yet, but it's directionally, not looking healthy for the US Treasury market. So in some ways, yes, because it gives them more exposure to long duration treasuries, which could potentially put them in a similar situation as UK pensions. In practice, I think that, given that they'd always backstop that with some degree of yield curve control if needed, in practice, I would not be worried about the solvency of the US banking system. In some ways, they're positioned the exact opposite of 2008 now. So in 2008, banks had very low treasuries and cash as a percentage of their assets, which meant that the vast majority of their assets consisted of loans and riskier securities. And so that's the portion that's subject to nominal default risk, whereas the cash and supposed the treasuries are not. Whereas now they're very highly allocated to cash and treasuries. And so they have, and so they have more of basically they would have to have worse defaults on the risky side of their book in order to have a similar event of what happened in 2008.
Right.
And so overall, I'm not really worried about U.S. banks, but it basically would stuff them with more treasuries if they decide to do that instead of putting those on the Fed balance sheet. So they have some options. It's apart from regulations. So various regulations have basically, it made it so that banks have to have kind of just more safe collateral. Mm-hmm. And then two, above that kind of minimum threshold, we've just not been seeing a ton of bank lending compared to prior rates. Banks generally in the U.S. and many other places have been pretty conservative, with exceptions like we see in some well-known European banks. Well, so before Europe had acute energy shortages, I was already viewing this as kind of an end game for this long-term cycle, which is basically that,
right,
we've had 4 decades of lower and lower interest rates and higher debt to GDP across the developed world. And, that when you hit the zero bound, or in some cases mildly negative, you no longer have an offset. So when debt is rising, but interest rates are falling, the debt servicing costs are, often flat. They're not going up. But when you have, a situation where interest rates are now flat or up, while debt as a percentage of GDP is also going up, that's when you have that very dangerous combination of actually higher and higher debt servicing costs, including at the sovereign level. And that's when central banks run into, a Kobayashi Maru. It's an impossible scenario that there's no solution for. And so, what they're supposed to do is if you have high inflation, you tighten. And if you have, low inflation, high unemployment, you loosen. That's kind of the model that they've been in. What breaks that model is stagflation. When you have both weak economic situation, financial instability, basically, too much debt starts blowing up, and you have high inflation. And so historically, like in the 1940s, which is the time we have to look back to find this combination for developed markets, you had major inflation, you had major currency devaluation, you had huge spreads between inflation and yields, and you had pockets of yield curve control and financial repression, which is basically all sorts of capital controls to prevent capital from moving around freely. You basically had to trap various entities into owning these bonds, and you had central banks buying the bonds. And so that's the situation I find I've been describing us as entering anyway for a couple of years, and we're starting to see that play out. Now, we've now added to it acute energy shortages. And really the only way out there is kind of emergency response, like to get more energy supply. Basically, countries should be doing everything in their power to, figure out how to get persistently more energy supply and to incentivize companies to go out and get more energy supply. Because for some countries, it is a national security risk at this point. And as you point out, it hurts the least resourceful members in society. The ones with the least ability to pay for that are the ones that are most impacted. And so the way I've been describing it is that we're going to get periods of inflation until we fix the energy system. And that's unfortunately that can take quite a while to happen. And so, when I kind of rank things that would keep me up at night in terms of markets, acute energy shortages are pretty much at the top. In developing countries, food and energy kind of compete for that top slot. In developed countries, you don't really have to worry about food shortages because there's more resources to fix that. And instead, it's about energy shortages because those are complex problems that take a lot of time to fix because grids are complex. Energy sources can't be changed on a dime. Import infrastructure needs to be changed. New wells and new reserves have to be created to produce more of the energy that's being in short supply. And so there's really no way out until the energy system is resolved, and that I think it's going to take years. So I think currency diversification is always reasonable. The caution I would give is that when we do reach a point where the Fed is unable to keep tightening, right? So it's really that rate of change that matters. When the Fed is tightening more aggressively than most other developed market central banks, the interest rate spread between what you get on U.S. assets compared to foreign assets is wider. And so, for example, there's a lot of incentive to sell Japanese assets and buy U.S. assets. But when that stops increasing, and especially if the treasury market breaks and the Fed's or the banking system is forced to do some type of liquidity operation to fix that, similar to the UK, that could be a structural peak in the dollar for a period of time relative to other currencies. Right? So right now, we've had the perfect conditions for dollar rally because we are more energy sufficient. We the Fed is tightening more aggressively. There is all these dollar-denominated debts throughout the world that basically represents demand for dollars. But there are major periods in history where you get a huge spike in the dollar and then you get a huge fall in the dollar. So with the U.S. dollar situation, one of the biggest weaknesses that the U.S. has had relative to the rest of the developed world is that we run these bigger trade deficits, which are normally bad for a currency.